Hello everyone, Steve Lentz here with Discover Options here at OptionVue. Welcome to this presentation of broken wing butterflies. And let me just say down here, I want to make sure everyone knows webinar has started, just to make sure has started. Okay, there we go. All right. Welcome everyone. It's August 28th, 2018. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So in this presentation, I want to thank you for joining us. We're going to go over a strategy that is a huge part of our Discover Options mentoring program. Discover Options is the educational arm of a company called OptionVue Systems International. OptionVue has been in business since 1983, primarily involved in the high-end options analytics field. OptionVue software has produced the most accurate theoretical values of options for many, many years, because we throw in our modeling everything, including the kitchen sink. It's incredible, and we've only been making further advancements where we've been incorporating vertical skew, horizontal skew, making those theoretical values in the future extremely accurate. Okay, but here at Discover Options, we have a series of strategies that we like to teach in our one-on-one mentoring programs. Take a look at this equity curve. Okay. This equity curve is from 2015. These are hypothetical returns starting in January with $100,000 in the hypothetical account, going through the middle of December. And each year I'm going to show you, we stop, for the holidays basically. All right, just to keep each year as a standalone situation. So here you could see, using our broken wing butterfly approach, the annualized return down here was almost 40%. with a drawdown at 5.1. Now I'm taking data points every 2 weeks during the year, okay, in the middle and the end of each month. So if I were to do a day-to-day one, you might see perhaps a bit of a larger drawdown in case I missed it, okay? But if you were to take a reading every 2 weeks throughout the year, this is what we have here. Annualized return of almost 40%, max drawdown of 5.1. Let's go to 2016 and take a look. Okay, again, starting with 100,000, going through into the middle of December and stopping. Again, right around 40%. That's kind of interesting. Look at that, right about, annualized was at 47.3, 47.3, and the max drawdown was just at 1%. Pretty amazing. Okay, let's go take a look at 2017. Annualized at 36.4, max drawdown at 1.2. Just awesome. What if you were to actually combine both years, and then every time your account grew, you began to increase the number of contracts you traded? Okay, so it actually increased over that time, as you would expect. If you're gonna start making those kinds of returns, you would start ramping up the size of your trading a bit, right? If you did that during that great 2-year span, it worked out very well for those 2 years, certainly. Annualized return then of about 60% when you started out with 100 at the beginning of those 2 years. And so that's kind of what you're looking at when you start ramping up the size for that given 2-year span, which admittedly was just outstanding. Again, we're capital required increasing with account size. Now you might be asking, well, what about 2018? How about your approach for 2018? Because we had that huge hiccup in February, and you are absolutely right. Huge hiccup in February. Oh, and by the way, I'm just showing you here for 2016 and 17 95% of them were winners, 20 consecutive winners at one point. Just outstanding. 2018 to date, up till August 2nd of this year, so January 1st to August 2nd, starting with 100,000, to date, the annualized return so far is at 12.7. Total return of 7.4. Not near as good as the previous years. Okay, and there's for good reason. I'll show you a chart of the markets. We all know what it looks like. The drawdown here was at 5.9, again, going into that nasty season we had. And again, if I were to go day by day, it might be a bit more than that. Certainly, I'm just taking a reading every 2 weeks. But here's what happened at the beginning of the year. That was crazy. Just crazy. The market plummeted 11.8% from late January into early February. And for any kind of a market neutral approach like the broken wing or condors or normal butters, I mean, those strategies typically just get demolished. Okay, but our approach didn't. Now, why is that? What drives this thing to make it work so well? All right, and that's what we want to explore. There's two reasons I'm going to go over with you today and just kind of introduce you to the broken wing and the advantages that it gives us. Number one, we're going to place positions that have a positive expected return, and that's what the broken wing gives you, with a high probability of profit. It's seldom you're going to get a positive expected return and a high probability of profit. So we're going to explore that in a bit and show you how to ascertain that by the use of graphic analysis charts. And most importantly, and this is one of the things that separates us from everyone else, is we want to place positions only when the SPX's market condition is more likely to be favorable for this approach. Is more likely to be favorable. So we are doing some technical analysis of the markets and doing some studies along the way. And we're going to show you exactly how we do that in just a second. Before we dive in here and get into the weeds on both of these concepts, full disclosure, we do have a broken wing butterfly mini course for you. It involves 3 recorded presentations, homework for you to do, with 3 live one-on-one sessions with one of our mentors, Frank Fahey. And those are one-on-ones. You can ask all the questions that you might feel are silly or dumb. Ask those questions in that one-on-one. No one else is watching. Okay? We give you 3 months of my Inside Wire research reports, the stock analysis report. I have hundreds of hours of archived research recordings as well for you to get. We also give you 3 months of OptionVue to use as well during that 3-month period to get really ramped up to speed on this approach. So more about this later. We have a special going on, $8.49 through Friday, and instead of $9.99. More about the special we're running through the end of the month later, okay? All right. Finally, before we dive into the weeds, know that if you do the broken wing approach in the SPX or the E-minis, the futures options, these are very liquid markets. The SPX cash options, over $1 billion traded per day. The E-mini options, over 63 million traded on average per day. Just outstanding liquidity for you to go and take advantage of this strategy in these particular markets. Okay? All right, let's get going. Placing positions that have a positive expected return and high probability of profit. What do we mean by these? So let's dive in and just start out by showing you a graphic analysis screen. And what you might be new to options, you might be a veteran, and you know exactly what these charts are representing. But for those of you new, just stick with me here. We're going to explain this very quickly. So in the world of options trading, these risk graphs are very important to understand. We have an x-axis, which is the price of the underlying, and as we move up in price, we move to the right along the x-axis. On the y-axis, we have a zero break-even line. Anything above this is gain. Anything above this is loss. Now, if we are long 100 shares of the spiders at 274.22 right here, see that? If the market moves up, say, $5, and you have 100 shares, how much do you make? You make $500 right there. Okay, and that's what we're showing down here in the P&L line. If the market goes down $5, okay, how much are you going to lose? $500. That's what you see right here. Okay, so that's how to read the actual amount gained or lost. Now, when we get into options, time is an element here. So we're going to show you multiple lines because options change in value over time. So we begin with the T+0 line. That's today's profit and loss line. If you were to buy 2 spider calls at 455 and the spider is at 274.22, and we bought the 274 calls, okay, this option position will make you $680 if the market goes up $5 today. If today the market goes down $5, the position will lose $474. See that? Now over time, the options prices change. Let's say in 18 days, let's highlight that line right here. Now we're highlighted right here. Okay? If the market then goes up $5 within 18 days, well, you're not going to make as much money because of time decay. And if it goes down 5, well, time decay and the direction change made you lose a bit more than you would have before on the day one. Now, there's something here called expected return, ER. So in 18 days, the expected return is 0. What does that mean? Well, what we do is we look at the bell curve of possible price outcomes here. And you could see the, let's see, I'm going to switch colors here. Okay, so we have the bell curve here. The first standard deviation, the second standard deviation is out here after the aqua. The first standard deviation lies within the purple line there. Okay, and what we do is we carve up this T+018 line, and we take data points. We take roughly 11 data points over the width of the bell curve, and we take the return levels from each data point multiplied by their probability of occurrence, average them together to get an expected return. And in this case, it happens to be 0. Okay, it's not going to be exactly 0. It's rounding it a bit. The standard deviation of those returns is pretty high. And then we have something called probability of profit. So what we do is we take this bell curve here, and then we look at the break even here. And so roughly 39% of the bell curve is occupied by a positive profit. The rest of it is occupied by loss. So only about 39% of this bell curve is occupied by profit, and that's how we get probability of profit. Let's go to T+36 days out here at expiration. Well, now, when we take our 11 data points, including way out here on the edges where we're making a lot of money, and down here it has bottomed out at a certain level like a long call would, our expected return is going to average out as positive. A lot of volatility of those returns. Probability of profit is at 36%. This is the only portion that's profitable up here. The rest over here is losing, so that's why we have a pretty low probability of profit. So I hope that helps you read these charts. Okay, now let's take a look at what a broken wing butterfly looks like, because it's pretty awesome. Oh, excuse me. One thing we have in OptionVue I want to show you is our price chart. We have an amazing tool here where we can take a price chart, we look at that trade, okay, and we can then color in a portion of the price chart. And if you're long calls, you need the market to go up, and this is where we're going to make money. If those, if the market doesn't move up and is flat, those calls are going to lose money in the red area. So we have this tool in OptionVue that gives you a great visual in terms of where you're going to make money, where you're going to lose money. Now, what is a broken wing butterfly? Okay, we've looked at a long call position. Let's examine what a broken wing butterfly is exactly. And so the way we teach this is we're going to be long one put contract that's slightly in the money. Then we're going to go in the puts out of them. We only do this in the puts for reasons called the vertical skew. Okay, we're going to go out of the money in the puts and sell 2. For every one that we purchase in the money, we're going to sell 2 contracts located out of the money with a delta of roughly 25 to 35, right in that ballpark. Okay. Then we're going to go way out of the money and buy another put contract, okay, So now we'll have one here, one there, and then selling two. So now we're balanced. There's no naked options here. Way out of the money, and we're going to buy a put contract out of the money a farther distance from leg B than A is from B. So A to B is going to be a certain number of points, so to speak. The difference between B and C is going to be much greater. Okay? Much, much greater. Let's look at an example of this. Let's say the SPX is at 27.52. We're going to go in the money, okay, to the 27.60 puts, and let's say we go long 10 of those. Okay, that's 8 points in the money, in the puts. Now we're going to go out of the money in the puts to sell 20, and the 2700 puts is 52 points away, 52 points out of the money, but it turns out it resides 60 points from leg A. See that? So we're long 10, short 20. Now we got to go long 10, and we're going to go way the heck out of the money to the 2590s. That's 110 points away from leg B. Okay, 110. Much farther. And this completes our broken wing butterfly. It's called a broken wing because a typical butterfly is going to have equidistant from A to B and then B to C. It'll be the same. But in this case, no, we're breaking it off and going way farther with this long strike that's way out of the money. What does this look like in terms of a risk graph? And this is where this thing really begins to rock. Look at this. We're looking at T plus 0, okay? And you can see kind of it leans a little bit to the long side. No matter how far the market goes up, the position is not going to lose money. That's awesome. So this way, in a bull market, okay, we're not going to be too upset if the market goes up. You know, so many people trade condors and butterflies in a way where they have all this exposure to the upside. And if the market goes up dramatically one day, all their other trading buddies are all happy, right? The rest of the world is happy, and you as a market neutral premium seller, you're unhappy. Well, there's a way to do this where you're going to remove the problems to the upside. And that's what we want to do. We want to make sure that if the market goes up, we're not going to lose money. And we're going to have the benefits of a market neutral approach that rewards us just like those other strategies do. So watch this. Let's go to T plus 10 days out. In time, the time premium is going to kick in. We're going to drift up to this next line up here. That's the T plus 10 line. See that? And now when you study this, if the market goes up, okay, if the market goes up, we're above the zero break-even line making money. If the market goes down, okay, we're way out, our break-even is way out here, way past the first standard deviation. See that? Way out here. So we now have a probability of profit that's very high. And if you were to take those 11 outcomes over the width of this T plus 10 line, you end up with a positive expected return. Isn't that great? Now, let's go further out. Let's go 20 days out and see what happens. Now, if the market goes down more, you're making even more money than if it goes up. Okay? Our probability of profit has gone up to 93. Our expected return rises even more. And by the way, our standard deviation of these returns is very, very small. It's pretty awesome. So you have a huge coverage of the bell curve of possible price outcomes here. And the farther out in time you go, you still have that high probability of profit. The expected return rises even more. And so you can see some huge advantages here. Now, one thing I want to show you is that if you notice here, you have the market leaning. This is kind of leaning a bit to the upside. If the market were to go down on the T plus 0 day, you can see you're going to lose money here. But as time goes on, our exposure here becomes really flat. Our delta is really flat here. And then here, on the next line up, we're actually leaning delta short a little bit. We're leaning delta short just a squeege. Do you see that, where the line's kind of angled up? So what you have is a built-in delta adjustment. a built-in delta adjustment so that as time goes on, the market naturally accounts for delta being long and then it's leaning delta short a little bit. So instead of having to add on put spreads and puts and all this to wind around, it's already built in. It's already built in. It's just a fantastic strategy. Okay, now, when you go and look at the price chart and you look at the coverage of where you're going to make your money, you can go out in time, a few weeks at a time, and you have a huge coverage of the price chart so that the market's really going to have to tank quick before you're going to lose money here on this strategy. And this is what makes this thing just so incredible. You have this huge coverage here. It's fantastic. The other thing we do, not only do we have a position that starts out with great coverage, but the other thing we do that's very important is on top of that, we want to place the positions only when the SPX's market condition is more likely to be favorable for this approach. Now, what does that mean? We want to avoid market conditions where we're more susceptible to this downside crash into the red area. And that's not that difficult to do. And here's what we do. Okay, many income option strategies assume that all market conditions are acceptable. And this is what I found. I did a huge study of the best practices for the broken wing butterfly. And so many of the folks out there, they will put the positions on pretty much no matter what the market's doing. Because if the market's going down, implied volatility is up, and now you're supposedly getting rewarded more for the risk you're taking. I'll tell you what, that's not how it works, okay? When the market's going down, yes, implied volatility is rising, but guess what? The market can end up being more volatile than what the premium is implying that you're collecting. And the market can get hugely more volatile than the premium you're collecting. And so there are definitely areas of the market, there are certain market conditions. And I've researched this in great detail, and it's part of our mentoring course. There are certain market conditions that you definitely want to avoid, because in those market conditions, it is far more likely that the market will end up being more volatile than what it is, than what the options are implying on the premium you're going to collect. And so part of our course is that we teach you about this and how to ascertain those conditions. Now, you might look at this chart and go, you know what, Steve, I'm looking at this and I think I can just draw a moving average and knock out all those red areas and keep most of the blue. The blue represents the market conditions you want to do this strategy in. Well, and you would be right. And this is the big takeaway today, is that if you're going to trade in this way, okay, butterflies, condors, any kind of market neutral, any kind of even leaning bullish, all right, you could just take a 50-day simple moving average, okay? And if you only do these positions when they're above the moving average, you greatly increase your odds of winning, okay? If you avoid trading these strategies when the market is below the 50-day simple moving average, good chance you're gonna avoid some nasty times. Now, we use two other technical parameters to really refine the entries when we're above the 50, and it's very important. And we throw in two other technical aspects. But I wanted to give you this great information today because you took the time to join us here, and this really is a great simple indicator to keep you on the straight path. Okay, but you should know that when we dive in, and if you sign up for our course, you'll get to know far more refined methods of ascertaining the conditions. So this is how we do our the 2 years resulted in 60%. Now, in all fairness, we do have our own approach to making adjustments, just a little bit about adjustments to get this kind of equity curve. We like to scale in halvesies. We'll scale in once and then twice, and then we do an adjustment approach that's very simple and easy. I have found that simple and easy is better in terms of rolling with the market rather than doing micro adjustments to stay delta neutral, etc. and we'll teach you that as well to have a shot at getting these kind of equity curves even when the market is bad. What kind of adjustments should you do? And we teach you that. But the strategy itself produces a fantastic risk curve, high probability, expected returns are positive, and we like to show you how to time it as well. The 50 days is a good place to start. Okay, now if you want to get started with this, we have a fantastic mini course. It's $999. It's $849 through this Friday. You could go to our website at OptionVue.com, go to the store, and you could purchase it. But right now, we are offering through Friday the 31st some reductions in all of our course offerings at Discover Options Mentoring. It's our August special. It's wrapping up this Friday. We offer several different tracks. Here's the butterfly broken wing track, or just a little mini course of 3 sessions. We have an intro to options. If you're just beginning, we have a great savings there. Earnings announcements. For those of you who'd like to do earnings, we have a reduction there as well. But when you get into the full-blown, if you want to go from an intermediate to an advanced trader and cover everything, we have the equity track and the full mentoring track as well, which would include the futures track for those of you that want to get into futures trading. Okay, you could go to our website at discoveroptions.com, go through all of these, and get a preview of all of these courses here, but I want to alert you to the special we have going. And if you have any questions, please come down here, and you can give us a call at 847-816-6610. And let me see if I can... I want to get rid of my, let me go here, see if I can grab this. It's not letting me grab this text. Okay, but we have a little store. Let me see if I can go grab it from another area. 1 second. I'm going to pop it in there so that you can, just a second. Let me grab this text, copy. I'm going to paste, hit enter. Okay. Going. Not just a second. Send. There we go. There we are. You can just grab that and go there, and it'll take you right to our store. Okay? Awesome. Any questions? Any questions along the way? We'll wrap this up, get this posted, and the recording sent out. Excellent. Folks, thanks so much for joining us. We'll be back next week with another little course for you. Okay? Take care. Have a great rest of the day. Bye-bye.